We're jumping straight into Micron Technology today. And, everyone is watching the historic price action.
Right.
But the real story, the core fundamental story is just the staggering acceleration in AI demand.
Yeah, yeah.
It's fundamentally resetting what we can expect from this company.
Exactly. You're tuned into a focused breakdown where we make sense of the market's biggest moves. And I'm glad you're with us because the numbers here are, wow, they're so transformative, they really demand a closer look.
And the numbers we have to tease right up front they're just breathtaking. We're talking about management guiding for Q2 revenue to hit $18.7 billion.
Which is a huge number on its own.
It is,
Yeah.
but the fact that the company expects such a massive sequential leap from Q1 revenue of $13.64 billion in just one quarter, that signals sustained, explosive expansion.
Right. That momentum is the core of all the excitement around the stock.
It's not just growth, though. It's profitable growth, and that's really the mission here. To take all this data, the financials, the analyst notes, everything, and distill what this AI-driven future really means for Micron.
And for your understanding of the whole semiconductor memory space.
If you're enjoying this focused analysis, make sure to subscribe and hit the like button. It really helps the channel.
It does.
And definitely let us know in the comments which stock you want us to simplify next.
All right, let's look at the bull and bear case for Micron Technology right now. The bullish argument is pretty simple in principle, but really complex in execution.
Okay.
It centers entirely on their ability to capture and dominate the high bandwidth memory market, or HBM. They're basically trying to become the memory backbone of the entire AI revolution.
So let's start with those financials that made everyone just sit up and take notice. The explosive growth is obvious in the revenue guide we mentioned, but the margins, that's where the story gets really wild.
That's the critical detail. Management is projecting a powerful 68% non-GAAP gross margin for Q2.
68%.
So for listeners who might not track this stuff daily, what does a non-GAAP gross margin of 68% actually tell us?
Well, historically, in a typical memory cycle, where the product is basically a commodity, margins might scrape 30%, maybe 40% in a really good year.
Right. A great year.
To see a projected 68% it's like striking oil. It signals that high bandwidth memory right now is being treated like a specialized proprietary technology, not a commodity at all.
Precisely. It's pricing dominance.
Yeah.
Pure and simple. And it's driven by overwhelming demand from the hyperscalers.
Yeah.
And to put that in context, their momentum coming into this was already picking up. I mean, the previous fiscal year showed something like 56% revenue growth and a staggering 180% net income growth.
So this is a business that's hitting escape velocity, and AI is the fuel. But, massive growth requires massive capital expenditure. This is where I want to pause for a second. Is this growth model sustainable? Can they do this without stressing the balance sheet?
It looks like it. And that's a fundamental part of the bullish argument. Their immense financial health. They have become a cash flow machine.
A machine.
In just Q1 of fiscal 2026 alone, they generated a record operating cash flow of $8.41 billion. So why should that number matter to you?
It matters because that cash is the foundation for their next big move, right? They have a massive $20 billion capital expenditure plan for 2026.
That's the war chest.
That's the war chest. They need to aggressively invest in HBM manufacturing capacity.
And the fact that they can fund an investment of that scale, largely through their own free cash flow, that means they're reducing the risk profile dramatically.
So they aren't reliant on issuing a ton of debt or equity to fund this AI future.
Exactly. They have resilience built right into the balance sheet.
Okay, so let's shift from the financials to what they're actually funding. This absolutely critical HBM moat that everyone is focused on. For our listeners who might not be tracking every single semiconductor development, can you just quickly break down what HBM is and why it's so essential for AI?
Sure. Standard DRAM is, the memory backbone for your computer. It's efficient, but it's slow by today's AI standards.
Right.
HBM is a stack of DRAM chips connected vertically. It allows for incredibly high data throughput or bandwidth. AI models, especially large language models, need immense amounts of data fed to the GPU all at once.
So it's like a wider pipe for the data.
A much, much wider pipe. HBM is the only viable memory that can keep pace with processors like NVIDIA's H100s. It's not a nice-to-have, it's a necessary utility for AI.
And this is where the supply dynamics get really, really interesting. We know the demand is crazy, but Micron's HBM capacity is reportedly fully allocated all the way through 2026.
That's it. That's essentially a 2-year locked-in revenue stream.
Right.
That allocation guarantees pricing power. If the top AI developers and cloud providers want the most advanced memory to build out their infrastructure, they have to compete for Micron's limited supply.
And pay a premium.
And pay a premium that drives that 68% margin. And if we connect this to the bigger picture, the whole HBM market is projected to grow at a massive 40% compound annual growth rate and hit $100 billion by 2028.
To visualize that, a 40% CAGR, that's not a normal market trend. That's like building out the entire interstate highway system for the digital age. It's infrastructure that has to be built.
It has to be built, exactly. And Micron is making a very conscious strategic pivot to make sure they capture as much of that build-out as possible.
And that involves getting out of some of their older businesses.
It does.
I found this move fascinating. They're exiting their low-margin consumer business, specifically that crucial consumer segment, by February 2026.
Yep.
This isn't just trimming fat. This is management pushing all their chips into AI.
It takes real strategic discipline to do that. They're sacrificing a guaranteed, even if it's slower, revenue stream from consumer PCs and storage. Why? Because the capacity that went into those lower margin products is now being pivoted entirely toward high-margin AI segments.
It just amplifies their focus and lets them chase those massive margins.
Right. And this focus protects their position within what is basically a DRAM oligopoly, alongside Samsung and SK Hynix. It's a tight field, but technology leadership is their defensive moat.
And their leadership isn't just in HBM, is it? They have other specialized tech.
Right. They have differentiated technologies in areas like automotive, these UFS 4.1 solutions, which double the bandwidth for next-gen vehicles.
As cars become basically data centers on wheels.
Exactly. Feeding data-hungry AI models.
Yeah.
This becomes another high-value, high-switching cost market for them.
That concept of switching costs is so important. Once a big client, like a major cloud provider or a car company, qualifies a specific memory solution, they embed it into their multi-year roadmap. It's incredibly difficult and expensive to just switch suppliers. It protects Micron's market share for years.
That integration is the ultimate structural defense.
So now let's talk technical momentum, because that's what confirmed the narrative for so many investors. The stock hit new all-time highs near, $294 after a massive surge of 240% in 2025.
And that sustained momentum, it just confirms a really powerful technical structure. We've seen some consolidation near those highs, which in a strong bull market like this is often seen as accumulation or reloading phase, not a sign that it's running out of steam.
And despite that huge run, if you look at its valuation relative to some of its AI peers, there's an argument that there's still value there. The PE ratio is noted at around 27 times earnings.
And if you compare that PE to a foundational AI peer like NVIDIA, which is currently above 31 times, it suggests that even after the surge, the market maybe hasn't fully priced in the future profitability from that 68% gross margin.
So the institutional conviction is strong.
Very strong. Analysts have raised targets. You see numbers like 325, 338, all rooted in this multi-year AI supercycle idea.
Okay, so that's a really compelling data-backed growth story. But knowledge is most valuable when it's looked at critically.
For sure.
We have to address the key risks. And for a memory company, that always starts with cyclicality.
Always.
I think this is the #1 question on every investor's mind. Has the infamous memory boom and bust cycle finally been broken by AI?
Well, historically, memory is the definition of cyclical. The top risk is still intense competition from the other giants, Samsung and SK Hynix.
Right.
While Micron has HBM dominance right now, if its competitors successfully ramp their own HBM supply too quickly, or if the market miscalculates demand, it could eventually erode those incredible 68% margins. Pricing could come back down to earth.
And because the stock has run up so much, a lot of future perfect growth is already baked into the price. That just raises the bar for execution, doesn't it?
It does. The stock is trading at a significant premium to some intrinsic value estimates. Some commentary says about 134% above those metrics.
So what does that mean for you, the listener?
It means the margin for error is razor thin. If demand stumbles, or if those Q2 margins come in even a little below 68%, you could see a sharp drawdown.
Because so much success is already priced in.
Exactly.
But, and this is a big but, the company seems so aware of that historical risk. And this is what could make this time different. Let's talk about management's guidance on supply discipline.
Okay.
They deliberately signaled that calendar 2025 bit supply growth will be below industry bit demand growth for the non-HBM stuff. What does that actually mean?
It means they are consciously choosing pricing power over just raw volume in their legacy segments. They are restraining supply to keep the market tight.
Which helps keep prices higher.
Exactly. Higher average selling prices across their whole portfolio, not just HBM. They're leveraging the fact that AI demand is so strong to cushion against that traditional bust cycle. They want margin, not just market share.
That's a really difficult tightrope to walk, especially when you think about the sheer scale of the investment needed for this whole pivot.
Absolutely.
I mean, the $20 billion CapEx plan plus the, what was it, $9.6 billion HBM investment in Japan, that carries huge execution risk.
Absolutely. We're talking about incredibly complex manufacturing on a global scale. The company needs flawless execution on factory build-outs, getting new equipment, managing yields, controlling costs,
Hitting timelines.
Any major delay or cost overrun on a $20 billion program would hit the P&L instantly and just shake investor confidence.
And even though they are focusing on Western customers, we can't ignore geopolitical risk. U.S.-China tensions and export controls are still a threat.
They are. That's a necessary hedge in today's environment. They're actively diversifying their manufacturing footprint and prioritizing customers in less sensitive regions, but the risk is just inherent to being a global tech leader.
So given this whole landscape, strong financials, incredible margins, but massive execution risks, what are the immediate catalysts investors need to be watching?
The primary one is the Q2 fiscal 2026 earnings report. That's expected late January or early February 2026.
And everyone will be watching for that $18.7 billion revenue number.
Right. Any confirmation of that, or even better, an upside surprise, will be a major catalyst. Specifically, you want to listen for management's commentary on HBM demand and future pricing visibility.
And then looking a bit further out, there are sector-wide events like the NVIDIA GTC conference in March 2026.
That conference is crucial. New GPU architecture announcements, or even just partnership announcements. They often require advanced memory and would confirm how deep Micron's integration really is.
Positive commentary from a huge partner like that would just validate the whole thesis.
It suggests the allocation constraint through 2026 is real, and the demand is still accelerating.
That's the lowdown on Micron Technology for today, covering the bullish acceleration and the critical risks.
And this raises an important question for you to mull over. When memory pricing is skyrocketing because of AI, and management is practicing this strict supply discipline, are we just watching another cyclical boom that's going to eventually crash? Or has the structural long-term nature of AI infrastructure spending fundamentally changed the rules for companies like Micron Technology forever? The difference between those two outcomes is, well, it's billions and billions of dollars.
If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.